Good afternoon, class. Not the ideal background setting for me to be recording this class, but we all have to make use of our time in the best way. So I'm trying to be efficient for you guys. Today we're going to cover Chapter 5, which is reviewing risk and return. The title is also Past and Prologue. So, looking at historical returns, how much those mean in the future, how relevant are they in terms of measuring risk. One fault of many risk measures that we look at as investors is that most measures of risk are backward looking and not forward looking, which can, bias your environment. Is the past or is the future going to be like the past? Is it going to rhyme, or is it going to be completely different? So some measures of risk might have that bias where it's backwards looking. One example of this that I struggle with is in terms of microchips and memory chips, in terms of how risky they are viewed as. Historically, microchips and memory chips were only used in desktops and then laptops, and then now they're in everything from your car to your thermostat. So historically, memory chips and processors are extremely volatile and have these big cycles of boom and bust. But due to the way we use microchips now, are they more like a consumer staple where we're going to consume microchips kind of through good and through bad? That might be an area that the market might miss if you're only looking at it through a historical lens. Or my thesis is completely wrong and microchips and memory chips are going to continue to have boom and bust cycles. So, that's one lens to look through it at. One other measure of risk that I often review, talked about it today to another class, is standard deviation. If you look at, let's just use something a little bit more basic, like the Celtics. If they score an average of 100 points a game and they have a standard deviation of 5 points, that means with about a 65% degree of confidence, I know that the Celtics are going to score between 95 and 105 points. Now, let's take that same measure of a 100-point average, and if they had a standard deviation of 20, that means now my confidence interval is now wider, meaning I'm only 65% confident that they'll score between 80 and 120. That's a bigger band and increases the likelihood that they might lose a game as opposed to consistently scoring 100 points a game. So, that's one way to frame standard deviation as we cover that in this chapter. Let me share the slides and then we'll get right to it. Taking a minute to load up here, so hopefully that turns on pretty quickly. And then, while the slides are loading, let's just continue to talk about risk. There's other ways you can look at risk. One other measure of risk would be a stock's beta. And a beta is historically how a stock moves with the overall market. So if you think about a stock that has a beta of 1, when the S&P 500 goes up 1%, then theoretically that stock should go up 1%. If the stock has a beta of 0.2, when the stock market goes up 1, this should only go up 0.2%. That should also apply on the downside. But again, remember, these are historical measures that are backwards looking. If a stock has a beta of 2, that means it's going to move twice as fast as the regular market. It's going to be a little bit more concerning. The slides are still not popping up for me. So what I'm going to do here, in an effort to get this video out, I'm going to, spoke too soon. Slides are good. So risk and return, as I mentioned. Holding period. So, when you talk about risk and return, the return part is super important. The return component is the holding period return. The most common measure for most folks is it's the return that matters to you when you bought the stock or asset versus when you sold it. And then also, what payments did you receive while owning the stock? or asset. This applies to any asset, not just a stock. I'll use the word stock as a proxy. But if this is an apartment building, it's what you bought it for minus what you sold it for minus what you bought it for, plus any rental income you received during the ownership of that asset. When this is a stock, it's more related to the income you get from a bond coupon or a dividend. What is a holding period return for a stock that was purchased at 25, sold for 27, and distributed 125 of dividends? Just some quick math says it's going to be $3.25 over the initial 25, right? So that's a 13% return. And how did I get the 325, 27 minus the 25 plus the $1.25 that were distributed? Capital gains is the component of the appreciation, and the dividend yield is the $1.25 it kicked off. Arithmetic average. That's a sum of the returns in each period divided by the number of periods. Then there's the geometric average, which is more common in investing. That's a single period return, gives the same cumulative performance as sequence of actual returns, and it compounds period by period, and it finds a per period rate that compounds that same value. So this assumes for compounding. Dollar weighted, and let me just distinguish between arithmetic and geometric, right? If I want to know what my annual return was for my clients, I just don't add up all the returns and divide by 3, because that's not representative of compounding returns. That's measurement of arithmetic returns. You have to use a geometric function of returns in order to get that annual compounded rate, the power of compounding. So you have to effectively unwind that. And then the dollar weighted average return. So, if a stock doubles, but you purchase more of it when it's already halfway up, you're not going to have a 100% return on your investment. Your return on investment might be close to 75% because you purchased one chunk at the bottom and then another chunk as it trended higher. So the stock's return doubled, but your dollar average weighted return did not do so. So rates of return of a mutual fund. So this is one measure up top is talking about assets under management, which is really nothing as it relates to you, the investor, right? That's just showing you how much money the manager has. There is always a risk if the manager has too little money, they could go out of business. Then the most important fact is the holding period return in terms of percentage. We're seeing 10, 25, and then negative 20, and then plus 20. Total assets before net inflows, right? How much money has come into the fund. Then we have the total inflow, and then assets under management at the end of the quarter. So we can see here the difference between these three equations here. The dollar weighted return measures when you actually got in. The geometric, which is always less than the arithmetic, right? Because it includes the compounding. Conventions for annualizing rates of return. Most people want annualized by year. You could compound it monthly, you could compound it daily. But, again, to fit kind of standardized norms, I would look to do annual compounding. And then effective annual rate, actual rate the investment grows and does not ignore compounding. So the other factor here is, why are we learning this? And this is, you're going to see a bunch of different ways in the field that people measure stuff. And this is just really letting you know that there's slight variations on the way things can be measured, right? And this will impact risk, right? You saw a couple slides back that, we'll go back to that slide. The arithmetic average versus a geometric average is a pretty significant difference. It's about 1.5 percentage points. So if you see an arithmetic average versus a geometric average, that difference of 1.5% is massive. To give you an example, if I could promise my clients that I could beat the market by 1.5% every year, I would be a rock star. That's actually a very impressive number to do consistently on a regular basis. So 1.5 percentage points Sounds small, but it's actually massive. If you think about the stock market returns 8% a year on average, if you're getting 9.5, right, that's almost 25% better than the entire market. Probably about 20% better than the entire market. So that, as a percentage of that percentage, is actually quite high. Anyway, going back, or should I say forward? Next, nominal and real interest rates. Nominal interest rate is the number that you see in front of your face. The real interest rate is effectively the power of that minus inflation. So how do you calculate that? What's 1 plus the real interest rate? Is 1 over the nominal interest rate divided by 1 plus inflation. So if we have a nominal rate of 1.1 and inflation is 5%, then the real rate would be 1.048 or 4.8%, right? Where you see again, the real rate, the nominal rate being 10%, and if inflation's 5, then the real rate is 4.8, and that's partly because of the way you do the math. You could back of the napkin that at 5%, but if you're going to get accurate to the 10th, 100th of a decimal place, you do it this way. You could, again, as I mentioned, not for a homework assignment, but in real life, take the real number, back out inflation to get pretty close to the real, right? Again, but however, you do the math the right way in order to get the most accurate number possible. Why are we doing this? What is the difference between the real and the nominal rate in the first place? Well, if you think about it, if inflation is 10%, but the risk-free rate, right, is 5, inflation really doesn't feel like 10 because you're getting 5, effectively you're 5% for doing nothing. It's only above and beyond that real rate that is what matters. Equilibrium nominal rate of interest. So this is the Fisher equation. This is the case in the case of money supply. The money market equilibrium exists where interest rate and money supply are balanced. Mind you, this is all theoretical and mostly an academic exercise. This doesn't matter all that much for kind of figuring out investments. Because what is baked into this equation? What is uncertain? Well, you're using already. The nominal rate is effectively the real interest rate, right? And then you're adding current expected inflation. Well, what if expectations are wrong? So this is another way to get an estimator, but it's not a fact. You're with this equation, you're getting another estimator, right? Because you're taking expected inflation and applying that forward. What if your expectations are wrong? Well, if your expectations on inflation turn out to be wrong, then the nominal rate that you calculated, ends up not being correct. But these are the variables that you work with within investing. Interest rates, inflation, and real rates for the last about 100 years. So, during the Great Depression, during that period in the 1930s, early 40s, what did we see? Massive inflation was pretty important in the red line. And then you saw T-bills versus real T-bills. So T-bills is the blue line. Real T-bills are the dotted line. Now, if you look in the blue, look positive during that period of the Great Depression. But there was so much inflation that the real power of those T-bills, was actually negative. If you think about it like this, if a treasury bill pays you 2%, but there's 10% inflation, you really lost 8% in purchasing power. So within this graph, that was the best example. One of the concerns that people have today with holding cash in accounts as opposed to bonds or stocks that earn higher levels of dividends or interest is that if you just hold on to cash, the potential inflation basically destroys the value of your cash over time. So, why aren't you invested in the market, even in a safe way, compared to just holding cash? Inflation and the real rate of interest. U.S. history of interest rates, inflation, and real interest rates. Since 1950, the nominal rates have increased roughly in tandem with inflation. The 1930s and 40s, that was very volatile because there was a lot of inflation. So that impacted those rates, as we just discussed. Scenario analysis and probability distributions. Scenario analysis, possible economic scenarios. They specify the likelihood of a holding period return. So probability scenario. Let's say there was a 20% chance the market's up 15%, a 20% the market is down 5%, and a 60% chance the market's at 8. You would take those returns and you would multiply them by each of their probabilities to get your expected return over that period you're analyzing. And that also finds the probability distribution. One outcome had 20%, one outcome had 50. There was different outcomes. Expected return is the mean value distribution of the holding period return. It's that value that you achieve at the end of the exercise, right? Variance, the expected value of squared deviation from the mean. Now, in calculus or statistics, you'll have to calculate this. Most of the time in finance, it's given. And the more important number is the standard deviation, which is the square root of the variance. But from a practical perspective, the standard deviation is really the movement around the average. We don't have to go into the details why, but one unit of standard deviation gives you a 65% confidence interval. We won't go into the detail in terms of why that is. We can talk to your statistics or calculus professor about that. But 1 degree of standard deviation is 65% confidence. So again, using that Celtics basketball example, if they have a standard deviation of 5 points, I'll be 65% confident that their score is between 95 and 105. Now, if you want to be 95% confident, I believe the 95% confidence interval, I'm going to cheat here and look it up again on my phone. Be extreme at any given moment. Next, slide 19. And we're back, by the way. We can see the slides again. So slide 19 is talking about deviation from normality and value at risk. Again, revisiting that topic. Kurtosis is another function that measures the fatness of the tails and the probability of extreme outcomes. So remember I talked about with the fire, right? That's an example of kurtosis, right? You're likely to buy fire insurance for the small risk of an extreme event. Skew is the asymmetry of the probability distribution. Is there more likely to be a positive event? Is there more likely to be a negative event, or a positive and negative events equally? Using time series of return, scenario analysis derived from sample history of returns, variance and standard deviation estimates from time series of returns. Again, the key factor here is that these are backward looking. Next slide here, comparing scenario analysis to normal distributions with the same mean distribution. So this is just looking at different periods and defining a normal period and applying that same standard deviation, because you're looking forward, you're going to assume that there's some element of the past that's going to be representative in the future. So you know that's why when you have extreme events like the financial crisis, dot-com bubble, even COVID, which we're in the middle of, kind of breaks these models because it falls into an extreme event. Oftentimes, extreme events like coronavirus, 9/11, the financial crisis, we'd call those 3 standard deviation events, which is a 3 standard deviation event is measured as a 99% chance, right? So, or a 1% likelihood. Risk premiums and risk aversion. The risk-free rate is that can be earned with certainty, meaning like you can put it in the bank, you can buy treasury bills. Those are proxies for the risk-free rate. Expected return in excess of that on a risk-free security, that's a risk premium. Like how much more risk are you paying above and beyond for that security or investment that you're obtaining. Excess return is the rate of return in excess of the risk-free rate, right? On this return, if I buy the stock in Microsoft, there's a higher return I'm expecting, but I'm also taking that risk, that volatility that the price moves in the wrong direction. Risk aversion, the reluctance to accept risk. For example, like I never want to go bungee jumping. I never want to have to jump out of a plane with a parachute. I'm averse to that type of risk. Price of risk is the ratio of risk premium to variance. How expensive is risk? Is risk expensive? Is risk cheap? Sharpe ratio, one of my favorite ratios, because it's used in evaluating other investment managers, as well as the information ratio. But that's the ratio of the portfolio risk premium to standard deviation. The Sharpe ratio is a measure of absolute risk. The information ratio is relative to a benchmark. So Sharpe ratio, mean variance analysis, how do you ranking portfolios by Sharpe ratios? So you take the excess return, which is expected return, over or minus the risk-free rate, right? What are you getting versus what would you have got doing nothing? And then you divide that by the standard deviation. Here are some historical Sharpe ratios during different periods. The highest Sharpe ratio is the best. So 1929 to 1955, safe assets performed best because that was a very turbulent period. And then in 1986 to 2013, highest Sharpe ratio was government bonds and large stocks, right? In the U.S. market, right, where most of us are living in the U.S., operating in the U.S., from 86 to 2013, the large stocks had performed best. Historical record world portfolios. There's about 24 developed countries. Think about U.S., Europe, Australia, Japan. In that group, consists of about 6,000 stocks. The S&P 500 are approximately the 500 largest companies in the U.S. Small cap stocks, they are approximately 20% of the index. And they have a large number, but they're small in size. World bonds. So there's a lot of developed countries that issue debt. Issuing debt is great if you have good credit, like most developed countries. And then U.S. Treasuries are measured by the Barclays Long-Term Bond Index. Again, here's just some samples of returns for the world portfolios, how they've done, what their lowest return year was, what the highest return year was. Um, you know, Ironically, you can look at the lowest return. Look at you. Lowest return was 1931, minus 45%. The highest return was 54%, only 2 years later. What is that a lesson of? Oftentimes, stay the course, buy the dip. Obviously, if you can afford it. This is a noisy chart, but it actually is really interesting because you see the volatility of stocks versus kind of risk in the black line, and then low risk bonds in the red line. Asset allocation across portfolios. Asset allocation is really important. Portfolio choice among broad investment classes. How do you allocate to U.S. versus foreign, or U.S. bonds versus U.S. stocks? That's your asset allocation. How do you allocate within stocks? Do you allocate equally to each sector, or do you try to match it up with the benchmark? My personal style is I don't like to deviate from sectors. I want to match the sectors in the S&P 500, but then do the stock selection within that. Complete portfolio. The complete portfolio includes the risky and risk-free assets. And then capital allocation is the difference between how you want to allocate to risk-free versus risky. In my world, the practical stance is there's no risk-free. I'm not usually using T-bills. I'm usually using corporate bonds. So it's more of a matter of, do I want to invest in risky stock or less risky bonds? The bonds I invest in typically have a correlation about 10 to 25% to the stock market. Meaning, if the stock market goes down by 10%, the bond portfolio might drop by 1. If the stock market goes up by 10%, they might go up by 1. But the reason we all own those bonds is for stability. Risk-free return, as I mentioned, treasury bonds would be in that group. Price index government bonds, money market, risk of CDs, all those are equivalent to the risk-free rate because it's the price of effectively doing nothing. Portfolio asset allocation, expected return and risk. So expected return in the complete portfolio is you're taking the percentage of assets in the risky portfolio, then you're multiplying it by the expected return of that portfolio, and then you're adding 1 minus the percentage of assets in the risky portfolio and multiplying it by the risk-free rate. So it's the proportion of the risky assets multiplied by the proportion of the risk-free assets and their associated returns. Next, you have the standard deviation of the portfolio, which is the standard deviation of the complete portfolio, which is the percentage of risky assets minus multiplied by the portfolio standard deviation of risky assets. What you don't do, you really don't do anything. The risk-free assets effectively act as a stabilizer to reduce standard deviation. The investment opportunity set is known as the capital allocation line, right? Allocating between risky and risk-free. You can have zero risk, and you can have 100% risk, or anything in between. That's effectively the capital allocation line. And again, defining again here, plot of risk-return combinations available by varying allocation between risky and risk-free assets. And risk aversion, that's your preferred capital allocation. And that's available risk premium to variance ratio versus required premium to variance ratio. This is defining this kind of emotion into a number. Like how much of a risk taker are you? And there's no perfect way to calculate this in terms of in practice, in reality. Like someone might say they have a high ability to take risk, but then when you speak with them, they actually have a low willingness, or they define risk differently than you. Passive strategy, that's again like owning the benchmark, as I mentioned before, like the S&P 500. And avoid security analysis, meaning you're just buying everything or selling everything. You're not looking at the individual names. Again, the capital allocation line is the market index using portfolio as a risk asset. So, as again, you can invest 100% in risk versus 100% in risk-free or somewhere in the middle. Costs and benefits of passive investing. Huge debate within the investment community on passive investing. Why should you do it? Um, you know, because it's hard to beat the market. Most investors and investment managers don't beat the market. So, and it's also expensive to try to beat the market, because if you're trying to beat the market, you're going to hire like some Harvard doctors and some analysts and some research folks to help you beat the market. But if their research isn't good, or it's not executed well, then you're paying a lot and not getting a lot for it, which is not a good deal. Or you can go passive, and passive is just owning the market. It's not as fun, it's not as sexy, but you can do it for like 0.03%. The fees on passive investing are extremely low. Expense ratios, again, are high. The expense ratio is really what hurts active management the most. Usually the fee is what they underperform by on average over time. That's what the numbers will tell you. Active management offers the potential for higher return. It's like a good baseball scout. If you do find that manager that can achieve a higher return, well, then they're worth it. And on that note, guys, that's the end of this chapter. Apologies for the technical difficulties and this terrible face angle. Like, see my double chin here. But next class, I'll be back in studio. But I wanted to get this posted for you guys. I hope you have a great afternoon. I think you guys are all doing a great job. Well, most of you. And if you're late on work, please make it up. If you haven't done it yet, please do it. And if you have any questions, some of you have been great about this, feel free to shoot me an email. I'm happy to answer them. And I'll try my best to keep on contributing on the message boards like you guys do as well. Hope you're having a great day.